All right. I just put that out.
So where do you want to start today?
It's a good question. I think that there are several things going on. I'm sure people would love to hear, um, about the typical growth, but I would just love to start with maybe more big picture, and that is if you look at a lot of some of these growth stocks over the last month, we're seeing kind of similar to like February, like 60% run-ups. Um, obviously people that are holding cryptos got a little damper during that. But talk to me about this, rebound, maybe starting around, I feel May 23rd was kind of like a little bit of a changing point around
Yeah,
that
I mean,
area.
and it probably coincides with the interest rates, the 10-year Treasury pulling back a little bit, from the 160s down into the 140s. I think more people are now. It depends which side of Twitter and which side of the investment landscape you listen to, but I do think there's more people out there that are starting to agree that this inflation may be transitory, or at least parts of the inflation may be transitory. I think lumber prices are down 30 or 40 highs. Steel prices have pulled back a little bit, like 10%. Copper prices are down. Those are obviously just parts of it, but and then there's oil and food and labor and housing and used cars and all sorts of other stuff. But I think more and more people think that we could see this inflation surge subside over the next 3 months, 4 months, 5 months. I think the Fed is saying that I think the Fed survey that either I heard this morning or last night, I can't remember, um, that they think the economy will be back to normal or at least pre-pandemic levels by end of year. Um, so I mean, I think as long as the 10-year Treasury stays where it is in the 145 to 155 range, I think growth stocks continue to do well. I mean, I'm down 4% today, in my portfolio. I was up 4% yesterday. So I'm just, one step forward, one step back. I mean, I'm not too worried about that, given, like you said, the nice rally we've seen in growth stocks over the last 4 to 6 weeks. I mean, I'm up pretty substantially. Now, I mean, I saw a pullback in the last. Now, since a lot of people were very happy the last week or so in their portfolios, I was actually losing money in my portfolio the last week, only because a couple of my largest positions pulled back 20% from their highs because of some stock offerings. But those two or three companies were also up over 100% in the last 4 to 6 weeks. So, they picked it. I mean, I'm glad they did these stock offerings after the 100% run up rather than before. And I actually just got off the phone with the Celsius Investor Relations Department. We had a scheduled call today, and like they're pretty freaking bullish. I mean, I don't think they told me anything non-public or anything that can't be found if you look for it hard enough. But the stock offering that Celsius just did, 6.5 million shares. Only 1 million shares of that was actually sold by the company. The other 5.5 million shares were sold by a handful of insiders that, on average, sold about 10% of their holdings, which means they're still holding the other 90%, which pretty much means they're still pretty bullish on the company. But a couple of these guys, like Carl DeSantis, I mean, he's literally been in Celsius since day one, or since the very first the funding round that the scientist that started Celsius raised from Carl. So he's been in there for over 10 years, and the guy just sold 9% of his stake. Big deal. That stake went from like 17 million or whatever it was to over a billion, like I think almost 2 billion, like 1.5 billion, because I think he owned like 30% of the company. So I like, and then the companies that the funds they sold those 5.5 million shares to are all large institutional funds like Fidelity and Wellington and those types of companies that are looking to build positions in Celsius. And this is a great way for them to get started with that. So um, the Nielsen scan data, like for Celsius, is literally off the charts. I mean, we're still tracking over 200% through the first 2.5 months of Q2, over 200%. So they told me that international growth probably won't be as good as I thought it might be, that I projected in my last write up, but that the U.S. growth is actually going to be probably better than what I said in my write up. And they are not going to have a can shortage, that they've already secured more than enough cans for Q2 and Q3. And they said even if growth goes to 300% year over year, they should be all right, because a lot of other beverage companies loaded up on cans in case they had a shortage, and their growth is nowhere near 200%, which means that some of those companies are actually selling their cans to Celsius. So, and probably losing money on those sales as well, because they're desperate to get rid of the cans since they don't need them right now, and they don't want to, they don't want it to hurt their earnings. So Celsius is in a very good position with cans, with demand, DSD partners, and everything else. So I got no worries about them. I think they said the DSD partners now cover, I think, like 90% of all Target stores and Speedway stores, which is enormous. And believe it or not, 70% of all energy drinks are actually sold in convenience stores and gas stations, which has been a big focus for Celsius and the main reason why they brought on these DSD partners. And something that I didn't know, or at least I had an idea, but didn't know the exact numbers. These DSD partners, it's the same group of DSD partners from Anheuser-Busch that took Bang from zero to $1 billion in sales 3 years. And Bang left Anheuser-Busch to go to Pepsi after Pepsi bought Rockstar. So those DSD partners came to Celsius as a group and, basically said, hey, we want to, distribute your products into all the same retail stores and gas stations and convenience stores that we helped get Bang into. So I'm still very bullish on Celsius, and the fact that it sold off the other day because of the offering, I think just creates a buying opportunity, which is why I have added to the stock as well as bought some call options. So, and then Upstart, is another one that's pulled back. That thing, the last time we did a Twitter Spaces, or it was either the last time or the time, but maybe it's two times ago
Two
when we did
two times
the,
ago was at like $90, and we were telling
yeah,
everyone to buy.
yeah. So it got as low as like 82 or 83 a couple days after that, I think, or maybe even that day or the day after. I can't remember
It was
exactly.
the next day. It was the next day, yeah.
Okay, so next day, and then I mean, I was obviously buying the whole way down, adding to my options positions, and then that stock rallied from low 80s into the low 190s. So well over 100% rally in just a couple weeks, and then as people realized that there was this lockup expiration, which is 6 months after the IPO, that some insiders might be selling. People started to panic and they sold the stock down all the way under 120 yesterday morning. It's back there today. I just got filled on some Upstart at 119. I could not give two effing whats about what Upstart does today or tomorrow or next week. I think this is probably a $220 to $230 stock by year end. So I think there's probably somewhere between 70 and 80% upside for Upstart between now and year end, just based on the fundamentals. And then you throw in the short squeeze and limited float and all of the other stuff. And the fact that Dan Loeb is already loaded up on the stock, he's got no intentions of selling his shares, I'm sure. So I just think there's going to be a lot of large, big buyer demand coming in for Upstart in the next few days. And once this stock starts to rally, I think we all know how fast it can move. I'm pretty sure anyone that's short the stock right now would probably want to cover and get out of the way. Otherwise, they risk getting run over again. So, the fundamentals are, support this story. This is not a short squeeze story by itself. This is really, really strong fundamentals. The company's already guided to 158% year over year growth. I think they do probably closer to 650, 675 for the year, which would be like 175 to 190% year over year growth, with 84% gross margins, 46% contribution margins, 11% net income margins. So I don't know if there's another US company that is growing over 160% with 4% gross margins and profitable. And the company said on their last earnings call that they have a 22% conversion rate from, doing their basically like B2C or DTC advertising. And then those leads get passed along to their bank partners, and then they get paid as a, kind of like a lead gen fee from the bank partner, as well as they get paid a fee, once that loan is originated by the bank partner. And then just if anyone didn't know, Upstart keeps about they do about 2 to 3% of the loans themselves, more for like research and development purposes, because if they want to test out new models, they want to underwrite those loans themselves using the new models as a test, rather than have their bank partners, basically be the guinea pigs on new models, new variables, etc. So 2 to 3% are done by Upstart, and then the other 97 to 98% are done by the bank partners. And then there's 100 institutional partners that are buying these loans. So, for anyone like complaining on social media that, Upstart's bank partners don't keep the loans, then they clearly don't really understand the industry, because that's true in mortgages, auto loans, basically every other credit. These things are packaged up and sold to large institutional buyers, endowments, hedge funds, etc., that are looking for credit and yield instruments. So it is very, very normal for banks to underwrite them or originate them and then package them up and sell them off to institutional buyers that, like I said, want that yield. And then someone will service the loans. It's either the institutional partner, or they'll bring in a third party, or in some cases the bank actually still services them. So I'm not worried about Upstart's bank partners selling off loans to institutions. That's very normal with the industry. Now, I mean, back to your earlier point, like where does growth go? I don't know. I mean, growth probably needed a little bit of a breather. 3 weeks ago, I got into some stocks for the first time. One was STEM, STEM. I got into that one at 18, and 3 weeks later, it was trading in the mid 30s. Clearly due for a pullback or at least a breather. Global E, ticker symbol GLBE. I got into that one in the low 30s just a couple weeks ago, and that thing got into like the 52, 53 range yesterday. That was probably due for a breather. So, I mean, there's a lot and I mean, we could go through, all the other more classic FinTwit names from, Twilio and CrowdStrike and Square. And I mean, a lot of these stocks have really rallied off those lows from a month and a half ago. So I'm not too worried about what today looks like. I mean, there's a lot of red on my screen. I mean, I'm looking at, my personal portfolio. My only stocks that are up today are Dario Health, which is up about 6.5%. Freedom Holding, which is actually like the FUTU version of, well, it's a company based in Eastern Europe, but they're essentially doing exactly what FUTU does, for the Eastern European and kind of Western Asian markets. And that stock, really strong fundamentals, looked really great on a chart, like about to break out to a new all-time high. It was up 5 or 6% pre-market. It's obviously pulled back with the rest of the crap today, but still holding in there. And then Danimer's slightly in the green. And then this new stock that I started a position in a couple weeks ago, ticker symbol is SKIN. The company's name is actually Beauty Health, and they do these hydrafacials. Lots of different services, facial services and whatnot. I think they even do like tattoo removals. But this is sort of a play on, a lot of their services are done in high-end salons and spas, which are obviously coming back post-pandemic. And then also they're done a lot of high-end hotels. And, obviously there's high demand right now for travel. People are going to hotels right now because they haven't been to one. I'm actually in a hotel right now. I'm in Boston for the next 3 days for some meetings. And then I'm going to Desktop Metal tomorrow to sit down with the CEO for an interview, and then get a large tour of two of their different facilities. So they have two main facilities in the Boston area, one in Burlington, one in Woburn. All of their metal stuff is done in one, and then a lot of the other stuff is done in the other, including their new wood printers. So I'm going to take a tour of both facilities so I can see the metal printers in action, and then the other stuff, which is the wood and this new material called Flexera for 3D printing dentures, and then there's elastomers and some other stuff. So I'm pretty pumped about that. I'm going to try to get some videos and pictures, and then kind of throw it all together into a with the interview for a YouTube video that I'll try to have posted either later this week or early next week. But I mean, this is literally my first night in a hotel in 18 months. Um, but there's probably a lot of people that are getting ready to go out to hotels for the first time in a while, and once they get there, they're gonna be looking for as much as as much. They're gonna be spending as much money as they can, and I think salon and spa services will be one of those things that they spend money on, and that's where a company like Skinning could benefit. But it's a name that most people aren't really familiar with. Smaller stock, but fundamentals really strong, and we'll see. I mean, that's a 1.5% position for me. So it's not a name that I'm loaded up on right now. But I mean, I trimmed a couple of my positions yesterday, and today I just did some adding. So I mean, so far this morning I've added to. I mean, when I say morning, I mean like the last 20 minutes before we jumped on this call. I added to Upstart at 119. I added to Celsius at 62.75. I added to STEM at 33. DM at 1205, Ethereum at 1502, FUTU at 150.80. So and Dermtech at 41.36. So like it's fine. I mean, I don't really care. I think too many people get wrapped up on what the market does day to day and how their stocks, whether they're up or down day to day, and it seems to like freak them out if they lose money one day. I just I'm a long-term investor. Like whether Dermtech's 41 today or 51 tomorrow, it's not going to matter because I'm not selling it anyways. Even if Dermtech went to 51 tomorrow, I don't think I'd even trim the position. So I'm just not in panic mode right now. Now, if the 10-year Treasury started moving up aggressively, or I was actually scared of the inflation data, then I might get a little bit more panicky and throw some hedges on, buy some put options, or raise some cash. But right now, I'm not sweating it.
Awesome. Definitely a few questions on that. And also, I'll just say for the audience, if anyone's listening, if you have questions that come up, feel free to go ahead and DM them to me. I didn't get DM too many questions yet, so I'll hopefully get through a few. Kind of back in the beginning, something that you mentioned. So I think a lot of people on Twitter have seen people talking mostly in jokes and memes about inflation is transitory. Can you just give like a 2 minute, 3 minute on like explaining that to the audience, like what that means and how that affects the stock market?
Um, yeah, I mean, so well, okay, there are certain sectors that would benefit from inflation, because if the Fed came out and said that we don't think inflation is transitory and we think it's here to stay, then they would be forced to raise rates. And there are certain sectors like financials that probably benefit from higher interest rates if it steepens the yield curve. There are some commodity based stocks that might benefit from that. But most stocks, especially growth stocks, would probably be hurt by that sort of wording from the Fed, meaning that it was going to be there was going to be rising rates in the future. So, but I mean the PPI data that we saw today, the CPI data we saw a couple days ago, the fact that they keep saying it's transitory, the Fed survey which basically backs that up. There's no reason to think that they are concerned about inflation in the long term. I mean, and I don't know what long term is to them, but let's say over 6 months, they don't seem to be very concerned about it. I also think that even if they did think inflation was creeping up, they do seem that their mandate seems to be kind of focused on employment right now. So as long as employment numbers stay weak, and they are weak right now, there are plenty of job openings. There's just not enough people willing to work and fill those job openings. So, if we started to see the job numbers increase dramatically, then it's more possible the Fed would, back off that transitory talk, or maybe not back off transitory talk, but maybe signal that rate increases could be coming at some time, second half this year. Because it seems like right now, with the way that they're wording everything, using the word transitory and just not worried about inflation, it sounds like they're prepared to not touch rates, short-term rates this year. So then you'd be looking at, maybe a rate hike in sometime in 2022. So if that changed, then I think the market would, probably freak out. But I haven't seen any data suggest that they're gonna come off those, that talk. Um, I think so I'm not a like I've said this, I'm not a macro guy. Like long term, I just don't give a shit what rates do. It's good, yeah, it's going to change short term prices and sentiment, but in terms of like the actual fundamentals of companies, long term valuations, it doesn't change any of that. It just changes the multiples, what people are willing to pay right now for, for basically for future earnings. So I think if so like in my I mean, I'm kind of bouncing around. In my opinion, transitory means it's temporary, that the data they're looking at is somewhat artificial because of what last year looked like because of the pandemic. Now, if last year was a normal year with no pandemic and they were putting up year over year numbers of 6-7%, then of course the Fed would be freaking out. We should all be freaking out because that's insane inflation. But if you have to take into consideration what last year looked like, with half of the world or more than half the world basically shut down, not leaving their homes, not driving to work, so they're not consuming gasoline, they're not going out to eat at restaurants. So of course, you're working off of negative numbers in some cases last year. So any numbers you put up this year or this quarter or this month are going to look high. But when they use the word transitory, I think they mean once we get past these artificially low, year over year comps from 2020, that the inflation data is not going to look nearly as bad as it looks right now. So, um,
Hmm.
and like energy is a great example, because energy, I mean, literally oil prices went negative last year. Because there was just, I mean, they were still taking oil out of the ground, and no one was consuming it, right? No one had to fill up their gas tanks because nobody was driving anywhere, and they literally had nowhere left to put any oil or any gasoline. So the price went negative because there was no buyers for that stuff. And I mean, that was like, if that's not artificial, I don't know what is. So,
Right.
um, so I mean, transitory probably means different things to different people. I've seen plenty of well-known, thoughtful macro investors on Twitter, with a completely different definition of transitory, or kind of making a joke out of it that, the Fed might say it's transitory, but it doesn't feel transitory because you go to the restaurant that you ate at 6 months ago and now everything is, 10% more expensive, or gasoline prices are at, 3-year highs or whatever it is, or, the used truck that you just bought, 2 years old, is not in a 30% discount like it should be. It's it's like 5% below the new sticker price. Like that stuff doesn't feel transitory, but the Fed is when they say that, they're signaling, or at least they're saying that they believe later this year that stuff is going to dissipate. Maybe not all of it, but some of it.
Okay. Got it. Appreciate the explanation. All right. We've got several questions that came in. I'm going to go through these. I think this one's pretty good. They said, obviously, some of the companies that we're pretty interested in have done raises, capital raises over the last couple of weeks. Would you rather a company that you are invested in raise capital via an offering or a long-term liability such as a 10-year loan?
Well, I mean, it's okay. So I know what he's trying to get at, but it doesn't work, I think, for his argument, because a lot of the companies that are doing capital raises are not profitable yet. So they're going to have a harder time actually getting some long term debt, or at least reasonably priced long term debt. This isn't like Apple or Facebook, raising debt where no one's worried about, there's no credit risk with those companies. I mean, I'm not like, I don't want to single out any companies, but let's just say, I mean, there's a company that is expected to lose, I don't know, let's just make up numbers. They'll do 200 million in revenue this year and they'll lose 50 million. Like that's not necessarily a company that's going to have an easy time raising debt. So for them, it's easier to raise equity. Uh, that's why most companies raise equity instead of debt. Debt is, in my opinion, and I think if you ask most people, debt is absolutely cheaper than equity, and it is probably the preferred way of raising capital for most companies. It's just not always an option for them. So
Got it. Got it. Good point. Okay. This one's from Encompassing Finance. They said, when do you think DermTech will get insurance coverage?
I have no idea. I mean, there's no way for me to know or for anyone else to know. I mean, the only people that know that answer are the people that work at the insurance company and work at DermTech. So I
Got
could
it.
I could make up some number, but or
Mhm.
make up some date, but that's not really a good idea. So, I mean, there's I think 33 or 34 Blue Cross Blue Shields. A few of them have approved or picked up coverage. They issued coverage on DermTech's patches. There's obviously a lot more to go. And then you have the big commercial payers like Cigna and United Health. So, I mean, we could get an insurance announcement tomorrow. We could get one next week, next month. I have no idea. But, there's a pretty large short interest in DermTech, and we saw how fast this stock can move when we thought that Cigna was picking them up about a month ago, and the stock rallied like 25% in like 2 hours, or might have even been pre-market. So I just can't believe anybody wants to be short this stock right now in the low 40s. That is playing a very, very dangerous game. It's my third largest position. I added to it today. I have no concerns about insurance coming eventually, but when it comes, we'll be happy shareholders. I just don't think. I mean, I'm not buying the stock. I mean, yeah, I would love an insurance announcement in the near future because I have call options that expire in July, or at least some of my DermTech options expire in mid-July. So the sooner the better. But I mean, I have no way of knowing when it comes.
Got it. Got it. Appreciate that. Pause real quickly. I have several more questions. Just for anybody who isn't already checking this out, I just want to give a shout out to Jonah's write-ups. I've been really appreciating your write-ups, Jonah. You just sent one out yesterday. I guess that was less of a write-up, more of your interview with Arthur Chen, CFO of FUTU. Just recommend people checking that out. And also, if anybody's unfamiliar with myself, my name is Gav Blacksberg, and I am the COO and voice of Wolf Financial. And I try to host spaces every single day, just bringing you all valuable content and post about the stock market. Now, I have a couple questions on
Let me.
STEM.
I'll talk.
Oh yeah,
I'll talk FUTU real quick, only
let's do it.
because I did do the interview yesterday, so everything that Arthur said to me is kind of still fresh in my mind. FUTU is my second largest position after Upstart. I mean, I've been pretty vocal all year, or at least pretty recently, that I think this stock is very undervalued. I mean, this was a $40 stock at the end of December, so it's obviously had a nice run, but revenues are also up, 350% year over year. So I think that the run up in the stock price is justified. And this is a company. I mean, they're clearly not going to be able to sustain 350% year over year growth. But based on my calculations, my projections, I think the company does about 1.2 billion in revenue this year, which would be about 180% year over year growth. Arthur says they should be able to maintain those net income margins of about 50%, which gets you to 600 million in net income for this year, which means the stock is currently trading at about 33 times earnings. Earnings. Like most companies out there that are growing at 180% would be trading at 33 times sales. FUTU is trading at 33 times earnings, which is insane. I don't know if I've ever seen a company in my life that was growing this fast, trading at this much of a discount on their valuation. So 33 times earnings while growing revenues at 180% and growing net income at about 240%, if assuming they put up 600 million this year. They just did a capital raise about a month and a half ago for 1.4 billion. Arthur said that that money is going towards international expansion, more product launches, building out the wealth management platform, possibly getting into insurance services, mortgage services, crypto services. They see, mainland China and Hong Kong are both big growth engines for them, but they're pushing pretty hard into Singapore and the US. And then I would assume that, North America, probably Canada would not be far behind. But they're doing a lot of things right. I've actually talked to a few FUTU users recently, and they actually love the technology, the desktop version for FUTU. They say it's way better than Robinhood and Webull. I know that FUTU is reaching out to influencers, out doing content, in webinars, interviews, all sorts of other stuff. They've reached out to me. I'm working on a couple things with them, which may or may not come to fruition. We're just kind of we're still debating what we want to do together. But I am a big believer. I don't know how much penetration they can get in the U.S. just because they are a Chinese company, and I think some U.S. investors will hold that against them. But I think that they can be a dominant player in throughout Asia, Southeast Asia, the Pacific. Maybe even get into Japan. We'll say Taiwan, that area. But for now, the fundamentals are strong. The valuation is incredibly cheap. Now we just, I thought the stock it looked like it was going to get a nice breakout today. It opened up in like the low 150s, rallied pretty hard into the low 160s, and then obviously pulled back with everything else. But I think FUTU could easily, just on fundamentals alone, this could be a $240 to $250 stock by the end of this year.
That's awesome.
And
And
then,
I definitely recommend. Oh yeah, go
yeah,
ahead.
one more thing. Look at the balance sheet and they think that FUTU has a ton of debt on the balance sheet. It's short-term debt that's being used to um, facilitate margin from their customers. So they basically borrow short-term money from banks and then use that to basically lend it to customers for margin and make, then there's, they make the difference. FUTU has no long-term debt. So, when people look at the debt ratio, the market cap to debt ratios or income to debt, whatever any ratios they want, it's misleading. It's 100% not long term debt. It's short term debt that's just used to finance margin.
That makes sense. I think we've kind of talked about that a couple of times and what they're doing with that margin and just really building up that customer base extremely rapidly. Okay, so a couple people are asking about your thoughts on STEM and kind of in conjunction with that, I think it's PLBY and STEM.
Yeah. So Playboy, I've never owned. I've never done any significant due diligence on it, so I'd be the wrong person to ask. There's a lot of people on FinTwit that have been all over Playboy for the last couple months. A few of them have been in my DMs. And this was probably a month and a half ago before the stock really started to rally. So kudos to them for pointing it out to me. It's just not, I don't know. I just couldn't get excited about it. I think what turned me off about Playboy was this whole NFT thing. And I just think in general, NFTs are stupid. That if any company that's kind of that was a big turn off. So I think I use that as just my rationale for not even looking into the company. But I think it's been a pretty decent performer, and they did a stock offering a couple weeks ago, and the stock snapped back the next day. So clearly there was some significant demand from shareholders for the stock. So I wish all I wish Celsius snapped back that quickly, but time. I think the estimate. So just and then I'll get to STEM, but with Celsius, so um, hopefully I can repeat this. There are at least two or three sell side shops that are going to be picking up coverage soon on Celsius, and then Celsius has a couple um, big investor presentations coming up where they'll be kind of virtually meeting with like anywhere from 50 to 100 institutional investors. So, and that's common. A lot of companies do that stuff. That is part of the job of the CEO and the CFO and the investor relations team is to do these road shows, whether it's in person or it's, over Zoom. Their job is to get more institutional investors interested in the company, understanding the business model, the financials, the strategy, blah, blah, blah. because they want those funds to obviously start building positions. And it sounds like Celsius has a lot of interest from large funds as well as the analysts that cover the beverage industry. So, and Credit Suisse picked up coverage the other day, or they already had coverage, but they increased. Uh, so they moved from a equal weight to an overweight, which is the same as a buy rating, and then increased their price target to, I think, 79 or 82. I can't remember. But the way that Credit Suisse does it is they have like their normal price target, and then they have blue sky and gray sky. So like their gray sky price target is if all kinds of shit goes wrong, and if their blue sky price target is if all kinds of everything goes right. And even though their price target in the report was, like I said, either 79 or 82, I can't remember, their blue sky price target is 96. So, basically saying that if the company continues to execute really well and, surpasses expectations, then the price target in our minds would be 96. And that's kind of where I have my price target by year end, somewhere in that like 95 to 105 range, assuming that they hit that they blow out Q2 numbers like I think they will, which will obviously force the analysts to raise all their numbers, raise their price targets, raise their ratings, and then they're playing the catch up game. So, STEM, yeah, I mean, oh shit, my computer's about to die. STEM is about 3% position in my portfolio. So it's now my 4, 5, 6, 7, 8, ninth largest position, just ahead of Grow Generation and Shockwave and SoFi and a couple others. They're all like bunch. There's like 8 or 9 stocks that are kind of all bunched in there between 2% and 3%. Um, so what I'm actually doing for my write up this week, I don't have any more core positions in my portfolio that I haven't done a write up on yet. So the stocks in my portfolio that are over 5% are considered core positions to me. That's FUTU, Upstart, DermTech, Celsius, Eterian, Desktop Metal, ClearPoint, Neuro, and Dario Health. So those are my 8 core positions right now, over 5%. Everything else in my portfolio is obviously under that, and in this case, they're all under 3%. So between 1% and 3% is like another 15 or so stocks. And I'm trying to like build up enough conviction in one of those stocks or 2 of those stocks to become a core position. I'm just not there yet. I was there on probably a few of these companies when they were trading much lower just a few weeks ago. But since they've rallied so much in the last 3 or 4 weeks, like I can't be, even though I really like STEM. I mean, I loved STEM under 20. I don't like STEM as much in the low 30s. I mean, even though I think it could go higher, I'm just not adding to the position at these prices. Same thing, SoFi. I mean, I jumped into SoFi a couple weeks ago, right after they de-SPACed in like the 19 or 1950, and then it rallied up into like 25 a couple days ago. I mean, like this is where I need to decide, even though I like some of these stocks long term, when they rally 25, 30, 40% in a couple weeks, sometimes you just have to take those profits. Sometimes you just have to close out the position, take a short term 30% gain. And then you know what? If it keeps rallying, then oh well, at least you had a nice trade. And if it pulls back, okay, now we can start adding some shares again. So I might do that a little bit more often because I feel like I got into some of these stocks at the perfect time a month ago, made a quick 30, 40, 50% in them. And now I'm starting to give back some of those gains, and it's driving me crazy. But, I think SoFi, I think it did. So I will add some SoFi in like the 21 range. So we're almost there now. Um, if STEM, I'd have to look at the charts, but if STEM pulled back probably to 32, I would probably start to buy some shares. I just think, I mean, the market they're operating in. I mean, the energy market is one of the largest markets in the world. STEM is obviously a combination of hardware, software, AI, and they announced a new partnership today with the company I didn't get a chance to read the press release because I've been on call since like 9 o'clock this morning. But something about funding projects. I'm not exactly sure what that means. I don't know if there's like a big financing component to it, but I don't know. STEM is going to be in this next write up that I do. So the way that I'm doing my write up this week is I'm not doing a deep dive on any particular company. Um, because I just don't have enough conviction in any other company right now at current prices to do a write up, knowing that a bunch of people are going to go piling into the stock. Um, so what I'm going to do instead is I'm highlighting 9 companies that I currently own that I've been adding to over the past month that I would continue adding to on pullbacks, and those stocks are STEM, Grow Generation, Shockwave, SoFi, MP Materials, Danimer, Redfin, Cleveland Cliffs, which actually raised guidance this morning, and the stock was up like 3 or 4% pre-market, and now it's down 2%. So, like some of these, I mean, sometimes the movements on days like today just don't make sense. You just have to chalk it up as one of these normalized pullbacks. And then I think that was 8, and the ninth one would be Global E. So I think some people have been seeing more Global E talk on FinTwit. It's kind of become like this little darling, kind of like a mini Shopify. There's a lot of things I like about the company. There's a few things I don't like. The things I don't like are the low gross margins, but it's still early days. The company's only about 8 years old, 9 years old, so margins are still expanding. And then it's just a recent IPO, so there's just going to be more volatility. And then with any recent IPO, you have to worry about getting through those six month lockups, and will the stock trade poorly going into the lockups, and is it even worth owning it before you get to that? But um,
Mhm.
but what Globally does is it helps power cross border commerce. So for companies, and the company's based in the UK. So for companies throughout the European Union or in the US that want to sell their products into other countries, that just opens up a whole can of problems from shipping to currency to, I mean, like literally language, translating stuff, and Globally helps with a lot of that. So, and Shopify, I'm guessing that Shopify maybe tried to buy them before they went public and was unsuccessful. So instead, they took about a 6.5 or 7% position in the company and basically named Globally like their exclusive, provider for these types of services. So, not a bad idea to have Shopify as one of your anchor long-term investors, sort of what Tencent has done for so many companies over the last 15 or 20 years. I mean, a lot of us love C Limited, Tencent's the largest outside shareholder. FUTU, Tencent's the largest outside shareholder. So, it's possible companies like Stripe and Shopify, that's going to be part of their strategy going forward. Finding the next generation of high growth companies in their industry, where they can add value, and then, making strategic investments and helping those companies thrive. I think just the other day or just yesterday, we heard that I think it was Shopify actually investing in Stripe's latest round.
Yeah, exactly. They did. Yeah, that was very cool. They put a good amount of money in. Okay, a couple others. So first off, thank you to the 300 plus people who are in here, and to those that have followed, sincerely appreciate it. Going to try to continue to put out quality content and spaces. Now, I got a question from Gary T. Gaines, and I'm going to mention this because Jonah this morning, after I posted that, I would have this space. You said I'll be there. Then Gary said one reply to this tweet, and I will tune in, and then replied his own tweet saying, "Okay, looks like I'm tuning in." So shout out to that guy for some humor. And he basically put a question in saying, Jonah has talked several times about waiting for some interesting SPACs to de-SPAC. Today, Proterra de-SPACs from ACTC to PTRA. Any initial thoughts or things you are looking for within the company?
What was the first one? I heard ACTC, which is going to be right, Proterra.
Yeah, Proterra, exactly. Any thoughts on that? It just apparently de-SPAC today.
Let me look it up. How's it trading so far? What's the new symbol going to be?
PTRA.
PTRA.
So it's actually, I mean, it's a rough day to, do it. It's down 5.5%.
Yeah, I mean, I owned LEV, which is Lion Electric. I got into that one I don't know, a few weeks ago in like the mid-teens, and then ended up getting out of it at around, I want to say 1950 or 20 a couple days ago, just because I wanted to raise some cash going into the Upstart lockup, or lockup expiration in case the stock sold off. I wanted some cash to add. So I dumped my LEV, I dumped my App Harvest. These stocks were, I mean, a lot of them traded down into the low teens, at the end of that whole growth pullback. They got up into the 20s, the 30s, the 40s. They all pulled back into the low teens. And then off of that bottom, a lot of them rallied 50, 60, 70, 80, even 90% in some cases. So I did take some profits in some of those, and then I'll be looking to get back into them. So Line Electric or Proterra, I will probably end up owning one of them. I'm just not sure which one. I've done more DD on Line Electric, which is why I owned it, and because it de-SPACed before Proterra did. But now that Proterra has de-SPACed, I need to do some more DD on it and decide which of the two I want to own. I don't think I need both in my portfolio. And to be honest, they might even, I mean, they'll probably trade pretty highly correlated to one another. So I'm not, I mean, I guess long term, one of them will outperform based on fundamentals, but short term, stocks like this typically trade pretty close to one another. Just like I'm investing in Cleveland Cliffs, but I mean, almost. Oh shit, my computer just died. Any steel stock, over in the short term is going to trade, highly correlated to other steel stocks based on, where steel prices go. So
Right.
yeah, so
One,
I guess the answer is I don't have any comments on Proterra. I just don't know well enough.
yeah, somebody just DM me saying PRTA, this is the first day pipe holders can short to box/hedge their shares, and that there's going to be a bunch of shorting pressure over the next few days.
That's possible. Yeah, I mean, you're going to see even more of that from the SPACs that de-SPAC, and they're close to that $10 NAV. Because once that NAV, or once that that redemption $10 price goes away, that's when the stocks are gonna fall. So I think the stocks that are trading above that price in the mid to high teens will hold up better de-SPAC than the ones that are trading closer to 10. So I think the ones that are trading closer to 10 going into de-SPAC, those are the ones that you should wait on and see if you can buy them, maybe closer to 9 or even below 9.
Got it. Got it. All right. Any thoughts on IRBT, iRobot?
Nope.
Apparently, yeah, no debt, 500 million in
Never looked
cash.
at it.
Okay. Never looked at it. All right. Any thoughts on the recent dip in INDI, Indie Semiconductor?
No idea.
All right. Fair enough. Question on Ethereum, one that you do know.
Yep.
Uh, Thoughts on why would Ethereum raise capital at $15? Is it possible that there's a problem with management? It's 65% down from highs. Could this indicate that they failed to refinance their
So
bad interest rate?
I did an update on Friday on Celsius and Ethereum after they both did their secondaries last week. Pricing sucks on both, but when you're selling a big block of stock to institutional shareholders, they're the ones that basically have all the leverage. So they're the ones that kind of name their price. So I mean, Celsius hit $83 last Tuesday. And then we found out, a couple of days later, they did a stock offering at 62. Ethereum rallied from the lows about a month ago at 12 up to 20. And then, of course, as soon as it gets to 20, we find out they do a stock offering at 15. So if, and I did this, I put this in my write up on Friday, if we don't get something from them soon, then I'm probably out of the stock because I'm just losing patience. There better be a good reason to issue stock at 15. And the only two reasons I can think of, and I don't think it has anything to do with, supply chain or any other problems related to the underlying business. At least I hope not. My guess is that it's either they have a one or two deals that are ready to, they're ready to pounce on or ready to close, and they needed that cash to, uh, to either pay for the deal or pay for a part of the deal. I mean, sometimes these deals are done all cash, sometimes they're cash in stock, sometimes they're, you know, part cash, part, like 10-15% cash. Like some of the deals that Dario Health was doing recently were like 10% cash and 90% stock. I think I like those deals more, but it depends. I mean, it depends on, where the acquirer stock is trading and the multiples, and then the multiples they're paying for the company they're acquiring. Like sometimes cash makes more sense. Sometimes equity makes more sense. You know, but like if you're buying, see, I think with Ethereum, I think Ethereum would prefer to do cash, because in most cases, like if you're buying a company for stock, like they go back to Dario Health, they're paying on average, at least the last couple of deals they've done, let's just say 10% upfront cash, 90% stock, and then there's performance bonuses that or earnouts or whatever you want to call it, because they're acquiring a company and they're folding that company and the team into into Dario Health, into the larger company. So they want those the founders of the companies they're acquiring to stay on board and help grow that segment of the business. It's different with Ethereum. Ethereum typically doesn't care who comes, and in most cases they don't really want anybody to come. They don't need the founders of these companies. They don't need most of the employees, because there's too much overlap there. Their whole thing is acquire a company for 4, 5, 6 times earnings, cut out 80% of the fixed costs, and then make these acquisitions even more profitable. So they don't really care if management comes along, and they certainly don't want to be on the hook for any sort of earn out or performance based bonuses. So I think Ethereum would rather pay cash. So if they're raising, I think they raised $40 million, right? Like 2.6 million shares at $15. So that $40 million, in my opinion, is either going to pay for an acquisition that's ready to close and be announced, or they're doing that because they needed to add $40 million to the balance sheet in order to finalize a larger credit facility from what they call a tier one bank. So they already said on the Q1 earnings call that they're talking to some tier one banks about a larger, cheaper credit facility, because the one they have out there right now is 8% plus warrants. So if they can get something bigger and cheaper, they can retire that credit facility, and now they're working with 5-6% debt, no warrants, and they can go out and be more aggressive with acquisitions. So, but it's possible, like in order to get their debt to equity ratios, in a place where the banks were more comfortable. Maybe the bank said, okay, we can give you $150-200 million credit facility, but you need another $40 million on your balance sheet. And maybe that's what it was for. If it's not one of those two things, I can't think of any other good reason, in which case I would lose, some faith and confidence in management and might be forced to sell my stock, and then take the loss in my portfolio. Because right now I have a cost basis around $24. So I'm definitely underwater, and it's a big red hole in my portfolio. And if I lose confidence in management, then there's no reason for me to not sell that stock, take the loss, and then revisit it in 31 days.
Okay, fair enough. A couple quick questions on more like Fed slash that area stuff. When you're interpreting what the Fed says, do you take it all with a grain of salt, essentially through a bit of a lens that maybe it's not all exactly what's happening, but more sometimes leaning towards hopeful to what they want to happen?
Yeah. Yep. I think, yep, that's true. And a lot of times, like, I'm not sure the best way to word this, but like sometimes when you have that much power in how, like, if you are looking for an outcome, you can say stuff that will turn the markets and lead them towards the outcome that you want. Um, I mean, let's not be naive here. Hedge funds do the same thing when they come on TV. Paul Tudor Jones was on CNBC yesterday, talking about inflation and commodity prices, and how he's positioning his portfolio. Like he's talking his book, right? I mean, he's like, if all those, if commodities started to spike, if gold started to spike, he would love it. If equities started to decline off of his comments, maybe he's in there as a buyer. So, yep. I mean, I take everything that these hedge fund guys say with a grain of salt. I take everything that the Fed says, maybe not so much with the Fed, because I think hedge funds are more likely to mislead us than the Fed is. But yeah, I think there's something to that. If the Fed is probably hoping to a certain extent that inflation is transitory, and there's no way that they can know, like for a certainty, whether it is or not. I mean, there's no way to predict what energy prices might be in 3 or 4 months, or lumber prices, or food prices, or anything else that goes into the CPI and the PPI numbers. So yeah, I think to a certain degree they probably are trying to talk the markets into their desired outcome.
Got it. Got it. One more question on that inflation type area. Um, how can people best assess inflation and build their own view? Essentially, what metrics to look at, the 10-year, the tips, break even, kind of what are you looking most closely at?
Oh my god, man, too much inflation talk. uh
Last one. That'll be the last inflation one.
yeah, I mean, I'm not at like, yes, there is definitely some inflation right now. I mean, I can see it when I go into my favorite sandwich store and pay $12 for a sandwich. And I know last summer it was like, a 10 or $11. I mean, that's just one little example. There's definitely some inflation out there. And I don't, is that sandwich place going to drop prices back down to $11 in 6 months? No, I doubt it. They're probably going to stay at $12 as long as they can. Other prices will come down. So I know there's inflation out there. I don't really know how to position my portfolio with my particular strategy, where I'm looking for stocks that I think can 5x over the next 5 years. And with my, monthly income and cash flow, I can continue adding to those positions on a consistent basis. So if there is some spike in, CPI data and the markets sell off 10%, fine. I got cash coming into my account every week, and I will just continue to add to my favorite positions. I mean, there are ways that you can hedge, obviously, against inflation, whether it's, TIPS, which are Treasury inflation protected securities. There's gold. I don't think Bitcoin is an inflation hedge. I'm sure some people might argue with that, but whatever. And then there's commodity prices. I mean, you can buy the underlying commodity prices, or you can buy the companies that, mine those commodities out of the ground. Um, so, I mean, there's ways to play it, but like, I don't know. I'm not smart enough to try to predict where commodity prices or inflation are going in 3 to 6 months. So I'm sticking to my strategy. I'm sticking to trying to find the best companies I can with the most likely shot at 5xing over the next 5 years. And, like I rattled off before, my 8 core positions right now were all stocks that I think can 5x over the next 5 years, maybe more than that in a couple instances. Like I think ClearPoint and DermTech and maybe even Atarian could be 10 baggers over the next 5 years. I don't think FUTU would be, because FUTU is already a $20 billion company. I don't see them going to 200 billion in the next 5 years. Upstart's already a $10 billion company. I don't see them going to 100 billion in the next 5 years. So maybe those stocks are actually some of the lower performers in my portfolio, but like, even if they just 5x over the next 5 years from here, that's still 38% a year. And then if I have a couple, 10 baggers in there from like a DermTech or a ClearPoint or a Desktop Metal, I mean, 10x over the next 5 years. I forget the exact number, but it's probably pretty close to double what you get as a 5 bagger. And then, of course, you get a couple companies in your portfolio that just turn into absolute crap and go sideways for the next 5 years. So I don't know. Like I'm probably the wrong person to ask. I'm not. I don't. I don't know. I'll never be a macro guy. I'm never going to um, build a portfolio based on what inflation data or interest rates may or may not be next month, or next quarter or next year. That's a really hard way to manage a long-term stock portfolio.
Fair enough. I got several more questions, but I want to make sure I'm respecting your time. What's your schedule like right now?
I could do one more.
Okay. Just one more question.
Yeah,
All
one more.
right. Then let's finish it off with, because I love following them. Will you, I guess, what options are you currently holding, and what option plays are you looking at for the next week?
I mean, once I turn my computer back on, I might actually do a little bit of option buying today, but I have call options right now on Futu, Upstart, Dermtech, Celsius, Desktop Metal, Atarian. I don't think I said Atarian yet, and Tiger. So I bought my call options on Tiger the day after they announced their secondary offering, and the stock was down like 8 or 9%. The options were down like 40 or 50%. So I jumped on some of those. I trimmed a little bit of them the other day when they were up like 80, 90%, but I'm still holding the rest for now.
What strike slash I guess dates for
I don't
FUTU?
even I don't even remember, and I can't even look at my computer right now.
Yeah, fair enough, fair enough. Okay, Jonah, anything else you want to say for I guess those
No,
the listeners today?
I think so. In terms of inflation, I mean, even though I hate talking about it, I hate answering questions about it because like everyone's expecting me to try to predict where I think inflation's going, which may determine where interest rates go, which may determine, where multiples go. Like it's all connected. I get that. It's just really, really hard to try to build a long-term stock portfolio and then worry every week about, this inflation data or job numbers or, any of these other data points that certainly impact the markets in the short term. Like I'm not going to deny that, but long term, I mean, if the 10-year treasury goes from 1.4, or, yeah, 1.48 wherever it is today, up to 1.6 over the next 2 or 3 months, like is that going to change my outlook for Upstart over the next 5 years? No, not even close. So like if the stock sells off because of that move, then fine, I'll just keep buying Upstart, as it trades down 5, 10, 15%, whatever ended up happening to the stock, based off of the rise in the 10-year treasury. So in many instances, like these short-term fluctuations from scary data, does create buying opportunities for long-term investors. So, I mean, this is why you don't always want to be fully invested. You want to have some cash available so that you can add on those pullbacks and those freakouts. So, I mean, I still think we're in a bull market. Interest rates are still very low historically. The Fed has our back. The economy is strong. A lot of people, a lot of balance sheets, both corporate and personal balance sheets, are as strong as they've ever been before. There is pent up demand in a lot of industries, and I think we're going to be in a bull market for the next 2, 3, 4 years, but it's going to be choppy. So just be prepared. Don't get greedy. Shame on me for not doing a little bit more trimming or selling the last few days in some stocks that were up 70, 80% in the last month. They were smaller positions. So that's, if they had been larger positions up 80% in a month, I would have been more aggressive on the trimming. But when you start with a 1% position and it goes up 80% in a month, like it's still such a small position. It almost doesn't feel like it's worth trimming, just endure the pullback and then add on the pullback if that's what you get. So, but I mean, like, I don't know, 2020 hindsight, it's kind of a bitch. But yeah, I mean, if FUTU or Upstart rallied 80% in the next month, I would probably trim, 25 to 30% of those positions. So just don't get greedy. Don't get greedy. No one ever went poor taking profits.
Wise words to live by. Jonah, we'll be back probably. We're doing bi-weekly.
Yep, bi-weekly.
All right, you heard it here. Me and Jonah will be doing bi-weekly. Jonah, really appreciate your time. For anybody else that's interested in more spaces, I will be doing one tomorrow actually with TrendSpider. Jonah, your friend at TrendSpider, Jake. Been chatting with him. That's going to be at 3:30
Cool.
p.m. EST tomorrow. And
Okay.
then I'm going to have, I think you're probably busy during that time. I figured we had one ours today. And then on Thursday, I'll be having another called Memes and Markets, and then a bunch more next week. So really appreciate everyone tuning in, and have a fantastic rest of your day. And hopefully we get some green going into the close.
Thanks, guys. Later.
Take care. Shout out Greg.